It's Tuesday, November the 16th, and this is your Mortgage Rate Watch brought to you by themortgagereal.com. So what's putting pressure on interest rates to move higher is the big question. Quantitative easing, too, is not being well received by the global markets. And internally in our governments, it's not being well received. The whole word of inflation and what's going to happen in the future with all this money being printed out has spurred inflation as the number one topic in financial media. And when you see it anytime you turn on CNBC, MSNBC, all they talk about is what could possibly happen with inflation. Now, looking at the numbers and prospects, what it's really going to break down to is when will inflation return and how dramatically can it return. The key thing here is with deflation, that helped interest rates to move lower. With inflation, it's going to put pressure on interest rates to move higher. And just the word of inflation, unfortunately, proves negative against the bond markets. So right now, if you turn on financial news, you'll hear the word of inflation, unfortunately, about every 15 minutes. And it's the key topic of debate and discussion. Now, what the Federal Reserve is defending themselves on is why they put QE2 into place is because there's still signs that our economy has not bottomed out and stabilized yet. And in fact, this morning with the CPI, Consumer Price Index, it is showing that those numbers came in cooler or less than expected, and therefore goes to show that inflation is not a concern yet. And with that said, it is backing what the Federal Reserve's actions are with this quantitative easing. Now, keep in mind that the Federal Reserve did come out to say that it will begin its purchase program, and the amount of money that it will use is all based on future economic data reports. So it's very clear that each time one of these United States, locally and internally, our economic data, the GDP, CPI, all of the consumer sentiment, consumer spending, as these numbers come to the market, it's going to show that whether the Federal Reserve and how much money they actually put out there, print and use, and how much money they retain. So this isn't going to be the same round, it doesn't sound like, as we had in 2009, where they just said, here we go, they're going to start buying this many billions per month. So to their defense, that's what it does sound like. Now, globally, it still is a dissenting comment as far as what's going on with the bond markets. It's not being well received. So unfortunately, as you continue to hear the word inflation, that's going to put pressure on interest rates to move higher. And right now, we don't know how much higher interest rates can move. What we have heard now is that many lenders are starting to forecast that they're going to see interest rates about the 4.5, mid to high fours throughout the rest of 2011. We're going to have those peaks and valleys, and hopefully we'll have some valleys where a lot of people that got caught off guard will be able to lock their interest rates in. Now, just a word for the wise, if you're in a purchase, and sometimes those purchase contracts, at least locally here in Washington, are 45 days or less, that is a huge gamble if you're not locking your interest rate at this point in time. Keep in mind to always work with a lender that has a float down option. We're going to plug ourselves here and say we do have those options with all of our lenders that we work with. It's very important to have that option, and if you're in the midst of starting a refinance, it's a good thing to create a ceiling. And we're going to talk about this here in a video clip we'll put out here shortly. That ceiling of resistance and floor of resistance. What that means to you is if you create the ceiling, that means that you're capped as far as how high your interest rate can go. So let's say it's at 4.25, and your interest rate can't go any higher than 4.25 because now you've locked. If the interest rates fall out because of bad economic data that we've been talking about, and interest rates move down to 4%, then you have the float down option. However, if you're not at least secured to create that ceiling, then you're exposed to how much higher interest rates can go. And in just the last 4 days, we have seen interest rates unfortunately slide huge. And you're talking going from 4% to 4.25 in little less than a day and a half. We were seeing dramatic price changes. In fact, yesterday, first time that we've seen in probably over 4 months where we had 3 negative price changes pushing interest rates higher in just one day. And that's unfortunately how fast interest rates can move. So make sure you're working with a professional that understands these key points in the market. We'll make sure to post any breaking news to our Twitter page. And of course, if you have any questions, feel free to ask those on the blog below and put any comments or feedback. We'll be back tomorrow with with more news on the marketplace. Talk to you soon.